You're listening to the Kelly+Partners Investment Office Podcast, where you'll hear directly from some of Australia's leading CEOs of private companies that are in a high growth phase where we've taken an investment position. Well, welcome to the Kelly+Partners Investment Office Podcast, where we get the senior leaders of investee companies and have them share their amazing stories. And this afternoon, we've got David Price, the Global CEO of Bizpay. Good afternoon, David.
Brad, thank you very much for having me.
Mate, great to have you with us. And Anoop, Kalra, our Chief Investment Officer of our Kelly+Partners Investment Office Fund. How are you, Anoop?
Good, thanks, Brett. Hi, David.
Well, it's 4:15 on a Friday afternoon, and that's an extra special time to have David join us. We always like to start at the beginning, David, because it's a good place to start. Can you share with us, your personal story, how you came to the career you've got and how you came into the role that you're in?
Sure. So I'm from South Africa. I studied my undergraduate in Johannesburg, South Africa, and I started my first startup in my final year of university. So I've always been quite entrepreneurial, and my first startup was reasonably successful. So the concept was similar to Groupon. It was putting discount vouchers onto mobile phones, and this was before there was a smartphone. So we used two-way SMS technology called USSD, and there was sort of a swipe barcode type of voucher that came up on the phone, and you could redeem a discount in various stores. Again, in a similar way to the concept of Groupon, so to drive sales for various companies. Then I moved to Australia. I studied a Master of Technology Management, which is like an MBA focused on technology companies. I also started a not-for-profit organization then, which assisted under 25-year-olds to launch social initiatives that they were passionate about in various groups. So we had a platform, which was a week-long event to help those under 25-year-olds brainstorm and then together launch various initiatives. And there were quite a lot of impressive initiatives that came out of that. And it's sponsored by very large companies like Westpac and Lend-Lease. I then wanted to get some corporate experience. So I went into the world of management consulting and private equity for a while. And I didn't really like the corporate world that much. So that didn't last too long. And that was also overlapped with the GFC. So it's perhaps not the best time to be in the financial services sector. After that, I went back into the entrepreneurial world. I launched a SaaS company in business ethics training. After that, I launched a social media company. And after the social media company, I launched Bizpay, which is this company which was initially called HiPay. So I don't want to just keep talking on. I'm happy to go straight into the origin story of HiPay and Bizpay, or if you...
Yeah, that'd be great. Tell us about HiPay and Bizpay.
Sure. So the founding team for HiPay was three former South Africans that found themselves spread across the world. So myself in Sydney, Phil Billamont in London, UK, and Alexander Simpson in Los Angeles, America. So it's quite an unusual founding team being spread right across the world. And the original name for the company was Zilch. And our concept was I'm extended family with Larry Diamond. So in the beginning of Zip and the whole buy now, pay later wave, I knew about it very early and was watching it and started to get a feel for when it was taking off and that there was a big opportunity. And in discussions with Larry, it became very evident they were hyper-focused on Australia only and had very little intention to go into international markets. And anyone that's met Nick Molnar from Afterpay, which launched after Zip but leapfrog Zip, he's an extremely laser-focused CEO, and they were hyper-focused on Australia and the US. So it looked like there was an opportunity in Europe. And the original concept was to launch a business-to-consumer buy now, pay later company in Europe and get critical mass, and then probably be acquired by Afterpay or something like that. At that stage, Klarna wasn't really buy now, pay later. And then what happened is we started to develop the technology, and then unexpectedly, Afterpay announced a partnership with Boohoo to enter the UK much earlier than we expected. So then we had a discussion, was it worth trying to fight Afterpay in Europe? They had a bigger bank account, very strong team, or should we try and find a different opportunity? And there was a split in the founding team. So Phil Bellarmine, he thought it could be done. He believed there was an opportunity to take on Afterpay and others in Europe. And I thought there was a better opportunity to look into other verticals. And so Alex and myself explored what else was available. And we saw that no one was really looking at buy now, pay later for business to business. So what actually has happened since with Zilch, and Phil continued with that, is Zilch has become the fastest unicorn in European history. So Zilch is the buy now, pay later that sits on the MasterCard rails. They've done very well, over 2.5 million customers now, and raised a large amount of capital, and that's going very well. Phil is still an advisor to Bizpay. But anyway, to pivot back to the original story with HiPay. So Alex and myself looked for other opportunities. We saw that there would be a very immense opportunity in business to business for a few key reasons. So businesses have more cash flow volatility than individuals. So a smoothing product like a Pay in 4, we saw would suit businesses even more than individuals. Furthermore, businesses invoice and they have to wait to be paid, whereas merchants get paid immediately, whereas business-to-business services, there are payment terms. So there's an opportunity to pay businesses that offer B2B services even earlier and help them with cash flows in addition to the revenue outcomes that buy now, pay later creates. And the market was actually was and continues to be even larger than the B2C market. So business-to-business invoicing globally is in excess of $50 trillion, whereas the B2C market is probably in excess of $20 trillion. So both are giant numbers, but B2B is substantially larger. What we had seen happen in terms of Afterpay leapfrogging Zip, the one key takeaway we had was Afterpay was hyper-focused on one vertical, female millennial fashion, and Zip went too broad. And so when we decided to launch into B2B, we said, which is the one vertical or niche we wanted to go into? And we chose recruitment because the concept was that companies that are using recruiters are hiring, so they're very unlikely to be a high credit risk. They're unlikely to be in distress. If they're hiring, they're probably healthy. So we wanted to process recruitment invoices in 4 installments, and we started off as HiPay. And HiPay went very successfully. We grew very fast. We raised quite a bit of capital very quickly, and there was quite a lot of hype in buy now, pay later, which made that relatively easy. And then what happened is we found that businesses had a lot of demand for paying various different invoices. So we were getting requests from our clients. We don't just want to pay the recruitment invoices. Can you not process anything else for us in 4 installments, like our legal invoice, our accounting invoices? And so what we did was we weren't sure if it was the right idea to broaden out, because we'd seen, again, companies like Zip broaden out and being very concentrated and focused as Afterpay was really worked better in terms of hyperscaling. So we brought in an independent research firm, and we got them to test the small business audience and see what was the demand like for companies that used recruiters to pay business invoices in 4, and what would the demand be like to pay general invoices in 4, any lumpy invoice that might create cash flow issues. And when they first tested the recruitment invoice, even amongst companies that used recruiters, the response was actually quite lukewarm. It was, I don't remember the exact numbers, it was somewhere like 4.5 out of 10 was the response. That's almost not a viable business, basically. It was really quite disappointing response, even though the business so far had been going quite well with high pay. When they tested the general concept of processing any invoice in full, so the range, just for everyone's reference, quite a good concept that's viable is a 6 to 7. An exceptional concept that should really take off with product market fit is 7 to 8. It came back 8.6 out of 10. It was the highest score the company had ever seen, the research company. So you had something that had immense market opportunity processing to any business invoice in full. And that was the beginning of Bizpay. So we changed from a one vertical niche focused product, high pay, to one where companies would be offered the opportunity to process any invoice they wanted in 4 installments. And demand was very high, and it took off from there. We started doing a lot of transaction volume, raising a lot of investment, and growing the team. That's sort of the beginning. So I don't want to just carry on with the story without letting you.
I know, it's great. It's a very, very interesting story, and you're covering, many of the questions we have. So,
okay.
How do you, I guess, on that journey, how do you find the great people? Who are the sorts of people that you needed? What are the I guess the challenges that you've had, and how have you addressed them, and where are you up to now?
Yeah, thank you. I think finding people is a progressive thing. So fortunately, we got to ride quite a wave of the hype that Buy Now Pay Later had, especially in 2020 and 2021. And there was a lot of capital available in both private and public markets for Buy Now Pay Later, and we took advantage of it, and there was a lot of media attention. So our brand was climbing, we attracted a lot of capital, and that led progressively to more and more high-quality talents being attracted to the business. So I would say in the very early days of the business, we had a small team and we lacked certain specialization, and we did make mistakes. So we didn't have enough credit and lending expertise in the business, and the environment was quite strong. So we did start to lend lots of money at high concentration to certain companies. And when that hit COVID, we did run into issues. So that is one of the challenges that we faced in a business with limited expertise. Started lending high concentrations in a healthy environment, and the environment changed very quickly when there were quite severe lockdowns last year. And we had a spike in arrears in our book, and that was the first big challenge for the business. But up to then, we'd just been having an exponential growth in transaction volume, just lots of clients flowing in, lots of capital, talent flowing in, and everything was going completely in the right direction up until the severe COVID lockdowns. And that was our first big challenge to deal with in the business. And at that stage, we had attracted, we'd already raised a very substantial round, a $23 million round in the second quarter of 21. And we'd been able to attract really key talent. So some of the best tech talent in the country, some of the best credit talent in the country, financial talent. So when the talent came to address that first challenge that we had, we put in new policies, procedures, technology, and you saw a dramatic shift very quickly from a spike in arrears to the arrears coming down very dramatically. Actually, to the point of at the end of last year, we were best in class, so outperforming all the B2C Buy Now Pay Laters in terms of our seasoned arrears. What is fantastic about the business-to-business model of Buy Now Pay Later is we do transactions of over $10,000 each, whereas on the B2C side, their average transaction is under $100. So our transactions are over 100 times larger. And so you have to be a little bit more careful in who you're lending to. But additionally, what does happen is if something does go into arrears, it's actually economically feasible to chase it down, to enforce, whereas that doesn't exist on the B2C side. So a combination between us creating enforcement policies and procedures, becoming a little bit harsher with late fee penalties, and not as a revenue driver, but just as a stick to drive compliance to make sure people didn't take out loans that they couldn't afford to pay. And although technically we are a loan, we've structured our product to be perceived by the end customer as another way to pay, a payment product. And that's very critical. So the only way you can sit on an invoice and not be awkward or insulting to the end customer is if you're seen as a payment product rather than a lending product. And to achieve that, you have to have a very frictionless sign-up process and not ask for a lot of information. If you look like a loan application, then people will think of you as a loan application. So we built very strong technology and artificial intelligence that's allowed us to make very quick or instantaneous credit decisions. And that allows us to really look like another way to pay or payment product rather than lending, and be perceived that way by the end customer, and to sit on the invoice. So if you imagine you receive an invoice from your law firm or your recruiter, it will have the two options: pay the normal way via EFT or bank wire, or click this button and pay by Bizpay. So we introduced that extremely seamless way to do custom acquisition, sitting on the invoices. And then we introduced a second product called Bizpay Anyone, where we said to those customers that had met us on an invoice, are there any other invoices you'd like to pay, such as your digital marketing firm, your research firm? And you don't only have to pay Bizpay Partners. With Bizpay Anyone, you can pay any invoice you like at all. And so we created essentially an open ecosystem or double-sided model where we can get distribution through suppliers, but then also be used at that end clients, other suppliers. So it goes from suppliers to end clients to multiple other suppliers, and just spreads extremely organically and starts to grow very fast. So once we'd learned to get our credit decisioning under control and have a really low arrears rate and created these mechanisms for very fast growth, we then started to run into our second challenge, in that the book was growing so fast, we didn't have enough capital to service it. So if you imagine starting to process invoices of over $10,000 each, and our customers on average process 5.6 transactions a month. So every single customer is doing over 50,000 a month on average transaction volume. You compare that to a B2C, buy now, pay later, their customers are only doing about 10 transactions a year, and ours are doing 70 a year, and each is much larger, over 100 times larger. So for a reasonably small customer base, the capital needs just blow up extremely exponentially. So we ran into a ceiling of where do you get capital to service all of this? And not only were we just generally growing fast, we'd also started to open up new distribution channels. So we had been focusing just on mainly professional service provider channels and verticals. And we'd started to open up large enterprise distribution, so big supply chains, as well as broker channels. And all of that places in a position where we really needed more capital than we could source very quickly. And that is kind of where we are now. So at the same time as we're really trying to bring a lot of capital in the company to service this very fast moving growth, the buy now, pay later market is the B2C side, because we're essentially, from our perspective, the only player on the B2B side. There are a couple of other small ones, but they don't have really substantial traction quite yet, or product market fit. So companies like Zip, OpenPay and others, their share price is down in excess of 75%. And so investors have gotten quite wary and scared. And so we're in this market now where we're have the challenge of convincing investors that we are buy now, pay later, but we're not buy now, pay later, because we're disrupting commercial lending, which is very different to disrupting what a B2C buy now, pay later is disrupting, which is essentially a consumer credit card or a lay-by service. So we're disrupting commercial lending. We have this installment model that is inspired by buy now, pay later, and it has a pay in four structure, but it operates in a very different way because each customer is doing tens of thousands of revenue for us each year, and the unit economics are extremely attractive, and we have very good margins and can become profitable extremely quickly. And we are projecting profitability by next year already. Whereas if you look at other buy now, pay laters, they have no profitability inside, even though they're a lot older than us. But even with all these facts that we position as best we can as talking points, it's still quite a difficult market at the moment. So we're progressively raising capital in our current funding round. Traction has been good, and it is progressing very well. But at the same time, if you compare it to 2021, we ran a funding round when Square just announced their acquisition of Afterpay. We opened and closed $11 million funding rounds in 3 days at that time. And this funding round is going quite a bit slower than that, but progressing all the time in the right direction. Investors are interested, but you have an environment where if you're even called buy now, pay later, some investment funds won't even be interested in hearing what you have to say at all. So it does make it a challenging market where you have to now find those investors that will look a little bit deeper and see that you have a good fundamentals and that our business is very different at scale and very profitable. So it's taken the best of buy now, pay later, which is a distribution model that scales very quickly, but it's fundamentally different on a profitability and unit economics level, and so can create a fundamentally profitable business at scale, which it looks like is extremely hard for the B2C buy now, pay later companies to do.
So does that mean, David, as you can get to profitability and not have to raise further capital?
It does mean that. So we're not there yet, but we can get to profitability by next year. However, we believe that the market we're operating in is going to be extremely consolidated or winner takes all. And there's only really two moats to protect us. So number one, we have the best in class and the lead in artificial intelligence, and that's really key. You're giving away a lot of money to various companies. You have to make decisioning very quickly at very high fidelity or credibility to ensure that you maintain really low loss rates. And buy now, pay later structured products, the fee that you charge is just a few percentage points. So you can't afford to have a lot of bad debts. If your bad debts just climb in excess of 2%, your margins start to disappear. So you have to have bad debt levels around 1% or lower. We believe we can get substantially lower, but you see the best-in-class buy now, pay laters on the B2C sitting at around 1%. So that moat that we've created of the AI decisioning is quite a substantial one. But the other moat is just scale and brand. We think we have to get very big very quickly. And the one advantage that we do have is it's very unregulated and has very low regulatory risk. Business to business, buy now, pay later, and commercial lending has really low regulatory hurdles. It's almost unregulated across the entire developed world. There's a few states in America, like California, where there is some regulation that you need to be careful with or get full licensing. But in other jurisdictions, it's quite easy. And we do have a strategy where we can go into certain countries without even needing boots on the ground. So, for example, if you think of a big four accounting firm, if we sit on their invoices in Australia and it's very successful, they can just turn it on in France, in Germany, etc. And we can process invoices there. So we need to grow very fast. So although we could be profitable quite early, a lot of money will be spent really driving growth and doing that land grab across the world. So from that point of view, I don't think there's much chance we won't be raising substantial amounts of capital for the next few years. It will be quite key to bring all that capital in to really accelerate growth. And the last point I'd like to make just about why the market will be so consolidated. If you think about an invoice, there's very limited real estate. So an e-checkout cart, which everyone's very familiar with, you'll recognize that there are always many options on an e-checkout cart. There's PayPal, there's Afterpay, there's Zip, there's Hum, there's Klarna, usually 4 to 7. An invoice will never look like that. It needs to look professional. So it will only have one buy now, pay later offering on it in order to look professional. So you have very drive towards consolidation at that point of payment on the B2B side. And you have this big global market. And what we saw with Afterpay, which is something we're structuring to do as well, if you go to Afterpay's website, you'll see all the merchants where you can shop with Afterpay, and they drive a lot of leads towards their merchants, new customers for their merchants. And we do the same. So we drive new leads to our suppliers. We suggest to our customers, would you like a law firm that offers Bizpay? Would you like, that is highly rated by other customer of ours? Would you like a good digital marketing firm that allows you to pay in full with Bizpay? And so we can generate referrals for our suppliers and new customers for them. And that creates a flywheel ecosystem. The suppliers want the most end customers or the most traffic, and the end customers want the biggest choice of quality suppliers. So bigger is better in that situation, like Amazon. So you have an effect where potentially it's close to winner takes all. And so that's just circling back to underline the point of it's really critical to grow very fast rather than just building a profitable business. It's really important to be big. And so we intend to raise lots of money to drive that growth as fast as possible.
I mean, at the end of the day, David, given you're funding a loan book, I presume there's a certain ratio of equity to debt that the business needs to have from the lender's perspective. Can you just talk us through where you are on those lending, that lending side of the business?
So far we've had a facility. Initially, we ran the book just on equity for the very early stages. And then around mid-21, we got our first facility, which was an on-balance sheet facility provided by a mezzanine funder, or you could possibly think of it as a venture debt funder. And, that's less than a year ago. So we don't have a lot of loan book maturity. And what we need, given the size we've already got into and the size we're projecting our book to grow over the next year, 2 years, etc., we need a large securitized warehouse, but we don't have a lot of loan book maturity. So that is the other challenge we have. So how do we get to the point where a major global investment bank or a big four Australian bank will provide us hundreds of millions of dollars in a securitized warehouse facility? And so we're in discussions with some of those institutions to see if we can get that over the line for right now. Or there might be a requirement that they want to see a little bit more loan book maturity. So even though our seasoned performance is really good, the book's not very mature, and they might, especially in this climbing interest rate environment where they're potentially becoming a bit more risk averse, want to see a little bit more maturity. So we're in discussions now with those larger players, which will either be for the immediate short term and extend into the long term, or might come into play in a few months down the line when we've matured our book a little bit. And we're in discussions again with other venture debt players and mezzanine players that charge slightly higher rates, but have a higher risk profile. So it really is a balancing act between getting enough capital in, not overpaying for debt, because if you have a very large debt book at a very high price, that can start to get very expensive. And also, as you said, there is some equity components to funding the lending book. So that does quarantine or take away your access to that equity capital for growth as it's needed to sit or on balance sheet or fund the book. So the capital requirements of the business, both on the equity, which plays into the debt side, and the debt side, are by far the largest challenge we're facing at the moment as a young, very fast-growing business that's capital intensive. And so what we are doing to mitigate that situation and the risks is we're having a lot of discussions both with local players and international players, and there's different risk appetites from different markets we're seeing. So that's really allowing us to hopefully put a lot of stokes in the fire and have many options at play, and hopefully we'll secure something that's very suitable for the business very, very quickly, so that we can go into our next phase of hyper accelerated growth.
And David, just if you were to crystal ball, where would you like this business to be in 5 years' time? We saw that Afterpay in a 5-year period really achieved some really spectacular growth. Where do you see this business being? And in some ways, although your class is buy now, pay later, I really think of you as a better way and a more efficient way of trade funding. That to me, that's what it is. That you improve the cash flows of both sides, both the seller and the purchaser of the good or the service, at a relatively small cost, and far, far cheaper than the traditional factoring or the commercial loans that either party would have to take on. So, where do you want to see this business, in whatever metric that you want to use, TTV or whatever, in 5 years' time?
Yeah, thank you for the question. So you're completely correct. We're not really buy now, pay later, and fundamentally we're a commercial lending disruptor, or as you said, a trade financier. And when buy now, pay later was the darling of the ASX and the whole capital market in Australia, it was convenient to wrap ourselves in that label, and that helped us attract capital. But now it's doing the opposite for us, being wrapped in buy now, pay later. It's sort of making things harder. So we do need to communicate to market that there's an aspect of us that's buy now, pay later, but fundamentally what we're doing is trade financing or commercial lending. So we will transition likely to that, or some combination. We'll have to see how things play out with buy now, pay later. It might just be, a terrible few months for buy now, pay later and it turns around. But we do need to have probably a more balanced messaging as we move forward towards IPO and beyond, of what we are at a fundamental level, and that we are our own thing. We're not really a buy now, pay later or a commercial lender. We're something innovative and new that's disrupting various financing functions in the economy. So where we're going over the next 5 years, I don't want to sound, overly grandiose, but our ambitions are to be bigger than Afterpay, and we are able to grow bigger than Afterpay. So Afterpay needs tens of millions of customers to get to the transaction volume where they are now, 8 years into.
And it's expensive to find the customers.
It is very expensive to find all those customers, and it's getting more and more expensive because you have PayPal and Apple Pay entering the market. For us to be as big as Afterpay, we only need 25,000 customers. So they're tens of millions versus our 25,000 customers. It's far easier to achieve 25,000 customers. There's more than 3 million small to medium businesses in Australia alone. There's over 215 million in the world. So we need a very tiny percentage of small businesses to build a huge transaction volume. So what we'd like to achieve, if everything goes according to plan, is to actually build a transaction volume in the tens of billions, which is substantially larger than Afterpay, which should be profitable at scale, because our model is profitable at scale. And then potentially go beyond that to a model where we probably need to be a bank or have a banking license of our own to generate all the capital that's required. So the very high quality problem of becoming so large that it's hard to find debt providers and you probably need to become a bank yourself is the best case scenario of where we'd like to be in 5 years. And the other thing we'd like to achieve within 5 years is to be something like a MasterCard or Visa, so universally recognized around the world, something that's potentially on any invoice in the world. If I want to pay my invoice the normal way, I do it via bank wire. The other way, if I want more time to pay installments, Bizpay is the globally recognized way to do that. So projecting out 5 years of transaction volume, I think anything beyond 2 years out becomes, really like sucking your thumb. And it's like, anything can sort of come out. In a best case scenario, numbers can get extremely large. We hope that happens, I guess.
Yeah, it's very exciting. It's very cool. So, David, I wanted to thank you on a Friday afternoon. We've done 8 of these today, so that's kept us off the street. And I don't want to jump into your weekend, but I always love to ask people, is there a motto, quote, or thought that best summarizes your approach to life and business?
I do have an answer, but I haven't made it into a nice, sexy quote. So let me just try and give you the concept, and then maybe at some point I'll turn it into a motto. But just conceptually, when things get hard, a lot of people crumble under pressure, go into their shell. So if you continue to stay calm under pressure when things are difficult and perform to the highest of your abilities, continue to take risks. So what does happen when things get hard is people become extremely risk averse to the degree of where success is almost impossible. Success, especially when you're trying to build something new or do something important in your life, requires some risk taking. Even when things are difficult. So if you maintain a reasonable risk tolerance, resilience, carry on through when things get tough, it always takes longer than you expect. So you'll have to be tough and keep pushing for longer than you expect. But there almost always is daylight at the end of the tunnel if you just really keep going, believe in yourself, have that resilience, and keep performing to the best of your ability. You'll get through to some outcome at the other side where there is a path to success. So
I think that's a great place to finish, and very, very true. We've got this view at Kelly+Partners that if you're a long-term person in a short-term world, you've got an outsized advantage. I think if you just keep going, it's a huge advantage. Thank you so much for sharing your story today with us and our investors, listeners, and future investors. I can't wait to be on this journey with you and see you progress.
Thank you very much, and thank you everyone that's listening, and look forward to crossing paths with you on Bizpay's journey in the future.
Terrific.
Thanks, David.
Thank you, Anoop. Thank you, David. Have a great weekend.
Thank you. You too.
Thanks. Thank you for listening to the Kelly+Partners Investment Office Podcast. We hope you enjoyed the show and found it informative and interesting to learn about our investee companies. If you love this episode, don't forget to follow us and subscribe to the show on Apple Podcasts or Spotify. As Brett says, have a great day.